welcome to Looking at the Markets with David Modell. We have a return guest. He is Mr. Kirk Spano. He is a frequent contributor to SeekingAlpha.com. I always look forward to his articles. I retweet his articles because they're so tweetable and retweetable. He's also behind FundamentalTrends.com. That link is in the description. You're going to want to check that out, and we'll talk about that. But first, we're going to talk about what's going on in the markets and perhaps some actionable investments. Mr. Spano, thank you for coming back to Looking at the Markets today.
Hi, Dave, and thanks for sending out the retweets every now and then. Somebody follows up with a good question.
Oh yeah, no, I love retweeting the good stuff, and you're always providing the good stuff. So let's talk about what's going on in these crazy markets. You know, you've got Alan Greenspan. Oh, he's back, talking about stagflation. You've got Larry Summers. Right. Well, he's not back. He just never seems to go away. He's talking about stagnation, stagflation, stagnation. Neil Kashkari is talking about secular slow growth. And I know you've discussed the idea of slow growth forever. That sounds a little bit scary to me. So how does what you've been saying jibe with what all these so-called experts have been saying about slow growth?
Well, I feel like they're catching up to me, so that's good. I first wrote about growth will never be the same and slow growth forever on MarketWatch a few years ago. And the major points are aging demographics are a major drag on the economy globally. And the aging demographics directly plays into the number of people entering the middle class globally, particularly from emerging markets. That big move happened over the last 20, 30 years, so we're not going to see another similar giant move into the middle class around the world that's as big as the last one, so that limits the economy. We have massive global debts, bigger than they were before the financial crisis, although the mitigating effect is, we've printed trillions and trillions of dollars, which is, good at one level and bad on another level. Warren Buffett has talked about, hey, we had to do it, but there's going to be knock-on effects down the road.
Yep.
And he actually made an investment recently, something that I had been looking at, so I jumped in after he bought. But it is a play on the future of inflation. And I'll talk about that particular holding in a second. And then, you have major geopolitical shifts going on around the world. China taking a bigger role in the world. That's going to continue. India will get there over the next 10, 20 years. So, when you add it all up and then you throw in the impact of technological change and in many ways being deflationary, you have these opposing forces of inflation and deflation, and then you have the central banks and the governments trying to manage it all. The possibility of unintended consequences and the black swan are clearly out there, but I think that ultimately things smooth out over 10 or 20 years as they usually do, and what we have to do as investors and people who need jobs is just pay attention to the ebbs and flows and control our emotions when something really bad happens and control our emotions when something good is going on, like right now in the stock market. It just keeps climbing.
Yeah, absolutely. I'm as a response to all of this, I've been tempted to get into UUP, the dollar index bullish ETF, and yet they keep printing money, at least here in the United States, and so I'm afraid to do it. When I listen to guys like Greg Manarino telling us that the dollar is just going to keep falling and falling, and he's been right so far, so that's not necessarily a trade that I'm going to take.
He's been right lately, so him and I have different time frames. He's kind of a 1-year guy. I wrote an article for MarketWatch back in 2012. When everybody was talking about the dollar was going to collapse, and I think the title of that article is "Strength Beyond the Balance Sheet." And if you Google it, you can find it.
Yeah.
Strength Beyond the Balance Sheet, and I talk about how the dollar is going to go on a big bull run. So back in April of 2012. I told everybody the dollar was going to go on a big bull run. And then when President Trump got elected, I made, and this had nothing to do with politics, because I think we have to manage our ideologies and our politics if we're going to be good investors.
Sure.
But it was clear that the dollar was going to take a short-term hit, and it has, right? So since President Trump got elected, the dollar's gotten beat up, mainly on the idea that we're going to pull back from international trade, but not because the United States is fundamentally weaker today than it was a year ago. The reality is that we really are the cleanest dirty shirt. So I would suggest that any dollar trade right now has to take into account that we might be in the middle of the range. And if we're in the middle of the range, you're almost guessing which way it's going to go short term, right?
Right.
So I try to stay at the edges of the range. When it was beaten up here in 2012, I said buy the dollar. And, a year ago when it was bid up, I said, yeah, I'd probably lighten up on the dollar. And now that it's kind of in the middle of a range, I think it's a tough trade. So, I mean, I will take the Charlie Munger approach to that one and say, is a decision that's too hard for me.
If it's coming from Charlie Munger, if he can admit that he doesn't know which way it's going to go, then maybe we should also be willing to admit the same thing. Very good, sir.
And that quote isn't for the dollar. I mean, Munger just says that the key to his success and Buffett's success is they look at so many things, and if they can't figure it out, they move on.
Right.
I can't figure out the dollar here for the next year. I do think there's a retrenchment. Because, as I've talked about with you before, I think the Chinese are going to start buying oil in yuan. So when they buy oil in yuan from OPEC, that's going to mark the deterioration of the petrodollar, which will be a hit on the dollar. So I expect that in the next few years. But very long term, it's tough to beat the United States because everybody has demographic problems. Everybody has debt problems. Everybody has, all the same problems. So it becomes a matter of degree, and there's not a country in the world that can do what the United States can do. We have resources, we have an educated workforce, we have good rule of law. Our politicians, for being corrupt and greedy, are less corrupt and greedy than most other politicians around the world. So, from a comparative standpoint, very difficult to be bearish on the United States long term, even if you are trying to make a trade in the short term.
Sure. I wanted to shift over to the oil and gas sectors, if you don't mind. You had an excellent article. You've had many excellent articles, but one of them was comparing XLE and XOP, comparing two popular oil stock ETFs. But lately, the drillers have been getting drilled. I couldn't avoid that little pun there.
Right.
Halliburton, Apache. I mean, they've just been getting hammered. Even when the price of a barrel of crude oil went from the low 40s to the high 40s, somehow it didn't seem to benefit the drillers. What do you think's going on here?
Right now, the traders are in control. There's just no doubt about it. You have a shortage of willing buyers, and you have trend traders who are pushing prices in particular directions. And that's going to go on for a while until there is a real big drawdown in oil, a really big statement from OPEC, or a war in the Middle East that would really make people take a look at buying into the oil picture again. I thought it would have happened already. I've been a year early on getting back into oil. I did catch a lot of it near the bottom, so I haven't lost per se in the last year and a half. But I've been treading water. 1 month I'm up 10%, another month I'm down 10%. And with the oil drillers, that oil services, equipment and services, is more levered to the price of oil than most E&P companies. So if you're looking to get leveraged to an increase in the price of oil, in most cases, you're better off buying either OIH, if you like the big service companies like Halliburton, Schlumberger, and Baker Hughes, which is in the middle of a strategic transaction, or XES, the one that I like, which is an equal weighted index. And you're right, I have an article in here somewhere. If you go to my profile on Seeking Alpha, you can find the articles. But I think that when oil prices go up, you'll want to be leveraged to companies like Helmerich Payne, the XES, and some of their holdings. I would avoid the companies that are specifically leveraged to deep water drilling. And there's a couple of reasons for that. The first is that there's really not much financing for deep water drilling. You've seen a slight uptick in the production in the Gulf of Mexico, but that's not because of really more drilling. It's just that the drilling they're doing is more efficient. So you're not getting more companies like Transocean doing more business. They're basically hanging on. They're still getting low day rates. They still have all sorts of idled rigs, both cold and warm. And cold idled rigs, that's a bad deal. That's expensive to get going again. So I'd stay away from companies like Transocean. I know that you're banking on a big move in deep water drilling, but that is a very slow moving animal. Right, you don't just say, "Hey, I'm going to go out and drill a deep water a deep water well next week." It takes years to plan those projects and get the financing lined up because they're so expensive. OPEC, I've talked about. At some point, OPEC is just going to tell the deep water drilling industry, "Hey, you start drilling too much, we're going to pump a lot of oil and put you down." So, and that's a threat that carries a lot of weight, right? Because they just did it. So, what's to say that OPEC doesn't reverse course if deep water drilling starts to get out of hand again in 2 or 3 years? Ultimately, the article I have on the screen right now is the Peak Oil Plateau. People go mental when it comes to the ideology there. Oh, there's no such thing as peak oil. Look, I call it a plateau because supply and demand are going to remain relatively level for 10, 15, maybe even 20 years. And during that time frame, I have a very simple thesis. The people who control supply will have more control of prices than demand would influence, because demand's just going to slowly keep drifting up until we start using more electric vehicles in 15 years? It's going to be down the road. Yeah. So we're going to get this window that's going to last a decade or longer, where OPEC and Russia, combined with the United States, which is plateauing right now on our production, we're going to be able to keep supply at the level of demand, or maybe even a little lower, and going into those inventories. Consider Saudi Aramco. Saudi Arabia has a huge motivation to get the price of oil up and then sustain it up for a while. Think of everything in oil in regards to two things, if you want to follow what I'm doing. I believe that Saudi Aramco is a major catalyst here, and I believe that there's probably a war coming with Iran. Or within Iran. Maybe it'll be a civil war. Who knows? But there's a huge coalition that's lined up against Iran. It's the United States, it's Saudi Arabia, it's Jordan, Egypt, and Israel, and then the rest of the Gulf cooperative nations. Consider that. Israel is aligning with Arab nations against Iran. So something's going to come to a head there. Either the mullahs and the Ayatollah are going to suddenly become nice. You think that's going to happen, Dave?
Yeah, right.
Right? Or there's going to be a confrontation, right? So what we hope, and I wrote about this, I shouldn't say I wrote about this. I was on a team where I got to pick up the coffee and get the books from the library and do some copy editing, that was writing papers for the Pentagon back in college. And they talked about the long game in oil and international relations in the Middle East. And they ultimately came to the conclusion way back in 1993 that at some point there has to be a resolution to the Ayatollahs and the mullahs in Iran, because they're just not good people. And I think that day is coming. Is it a year away? Is it 3 years away? I don't know. Your guess is as good as mine. I'd say probably within 3 years, and that'll be a major, major catalyst to the price of oil.
So bottom line, and people should know that I am not a licensed or registered investment advisor. Nothing in this video constitutes a recommendation to buy or sell anything. You have to do your own research. Having said that, let's get to the bottom line, shall we? For example, XES, which you turned me on to a while back, something I hadn't really focused on. If somebody wanted to get into it now, XES, OIH, XOP, or none of the above, or stock picking.
Well, all right, so I'll give you some of my favorites. I do own XES, and with it getting hammered again, I think I'm down 20% already. I'll probably sell some puts. I'll take a look at the quantitative analytics, the trend following stuff, and I'll take a look at some technicals. And when I break down these ETFs, I take a look at the top 20 holdings or so. So in the article that I have in here, you can take a look at how much different some of these ETFs are compared to what they were years ago. Let's see here. There you go. I break down the holdings within these ETFs. These are the oil services and equipment ETFs. And I talk about how the indexes have shaped up. So in just XES, a lot of these companies, these are all companies that are no longer in the index that were in that index 3 years ago. So those indexes are much, much stronger. And what you can find is that there are some of those companies in there that you're going to want to just buy. I like Helmerich Payne. Might even not be saying that right. But for them to be getting beat up as bad as they're getting beat up is astounding to me. Yeah. They have a great position in onshore, and they have a light but good position in offshore. When I say light but good, I don't want a company that's dedicated to offshore, especially deep water. The shallower stuff with the jackups, I think is all right. But, if you've got nothing but semi-submersibles and you're going super deep, man, those are the expensive projects. There's not going to be many of those. So I think that that's a good company. I think for most people, just buying the fund. And here's the thing for option traders. And I know you trade some options. Because volatility is high in certain parts of the market, if you can find parts of the market that you'd like to get into for a reversal, selling cash secured puts I've always thought is a wonderful idea. Right. Because the downside is you end up owning a good company cheap, or is that the upside? And then the other side of the equation is if the holding goes up before your option expires, you just have to keep that big fat premium. Yep. There's big fat premiums out there right now for selling puts.
Sure.
So if you can find something that's undervalued and sell a put on it, it's a pretty good deal.
It's a great deal. Getting paid to wait for a price to possibly go down to your target price. Much better than just placing a limit order for 100 shares. Why not get paid some premium in the meantime? And if it never gets there, it never gets there. You get to keep the premium. I love it. Right. So, very good, sir. Wow, lots of great articles. I will be putting links in the description for sure. Let's talk about your website, shall we? Fundamentaltrends.com. There's so much stuff on here. You got your multimedia, you got your forum, reports. So what's new on Fundamental Trends?
Well, what's new is that I actually set up a sister service through Seeking Alpha called Margin of Safety Investing. The two services are essentially similar. I'm recommending the same stuff. A lot of the writing overlaps. But I have written a couple of reports, and they're actually free to the public at Fundamental Trends. You have to subscribe to the other service to get these. But this is a report that actually is due for updating. Asset allocation and my core 4 approach to investing. I really just talk about the fourth, asset allocation in general based on Ben Graham theories, how I've modified those. And then the core 4 is I look at 4 fundamental criteria for picking out investments. 1, what are the big secular trends? I want to get on the right side of those, or bet against companies that are on the wrong side. Government and central bank actions. I don't want to work against the government and central banks. Don't fight the Fed. Right. Don't fight City Hall. Third, your basic fundamental analysis of companies with a forward-looking outlook. The forward-looking outlook is what most people can't do. And then I also use price trend following. And I know that some people only do price trend following, and other people call it voodoo. I include it as part of my fundamental analysis because ultimately you do have to respect the movements in the market. Now, to me, short-term movements that traders create, like with XES and some of the oil stocks, are buying opportunities because I have a longer time frame. I'm a position trader. I'm going to own what I buy for a year or 2 or 3, or my longest held holding right now is 9 years. So, I'm not looking to flip a trade and try to make 20 or 30%, which is a great return if you can do it over and over again. But what I'm looking to do is have 20 or 30 investments at a given time. I'm below 20 right now because I'm 25% in cash. And I want investments that are going to double at a minimum over the next 3 to 5 years, but I have a chance to triple, quadruple, or be a 10-bagger. And I'm very Peter Lynch oriented in how I pick out my investments. It's proven to be pretty well. Yeah, right? I mean, the Peter Lynch approach works.
Yeah, I agree. And you're not freaking out if one of your positions goes down 10%, let's say. It's not even a blip on the radar to you because you're a position trader. You're looking at the long term, you're pulling back the chart, you're looking at the fundamentals and the price action. You're looking at the charts as well. It's part of it. It's all part of it. And it's all there on your website right there. What else is available on your website right now?
Well, I do have the multimedia stuff. You're in there a couple times, or you will be in there now a couple times.
Cool.
I'm moving at the speed of the internet here. And the nice thing at fundamental trends, I'd say compared to margin of safety investing at Seeking Alpha, is that I have a forum here at Fundamental Trends that really has we skipped the July call because everybody was doing July stuff, but we'll bring back the monthly investor call in September. I've got literally hundreds of threads in here, and one of the things we do is we track what I call my very short list, which is actually up to close to 80 companies. We just haven't talked about them all. And what I do is I post my notes, my research notes, and then people ask me about the research notes and I answer them. So this is a real nice setup. As you can see, some of my favorite stuff: Intel, Potash Corp is a backdoor play on lithium. I don't think people know that. I'm writing an article about it now. And Kana, I think, is one of the best oil stocks because of their position in the Permian. And they also have Eagle Ford assets that I think will probably get sold. And then they have great natural gas assets in Canada, which will be long-term plays. Somebody asked me about Mosaic. I said, no, do potash instead. I did put out a trade alert on this in the last week for selling puts and setting limit orders. 8.3 Energy Partners, I'll tell you what, if you want a company that's going to do very well over the long term, I would take a look at 8.3 Energy Partners. They're about to undergo a strategic transaction, and I think it'll turn out nothing but good. Store Capital is a backdoor play on inflation because this is a REIT that got beat to heck because of the Amazon effect, right? Amazon beat up retail.
Sure.
So this REIT got beat to heck, and the real estate holdings in there are just worth a fortune. So even if they have to change tenants, who cares? They own the real estate. So Store Capital was one of the very rare REITs that were undervalued for a while. There's a couple others. The retail REITs out there right now, if you're looking for REITs, look at those. They've gotten beaten up. They're cheap compared to their underlying real estate values. There's a handful of them that I'd be taking a look at. Store Capital is my favorite. Sun Power, their patron is Total. I'm a big fan of Total, the oil major. So, you take a look at those. Super Value, I haven't really identified yet, so you guys are getting a sneak look here at this page. Super Value, they're probably going to get bought out next in the grocery chain because they have the best wholesale network, which would fit in very nicely with delivery of groceries. And they have some retail stuff that could maybe get sold off. First Solar, I'm not real high on right now. I don't like their supply chain. Amazon's too expensive. Tesla's another one I stay away from. I've traded it a couple times. And then this is the company that I've been in for 9 years, Exact Sciences. I've made over 1,000% on this one twice.
Nice.
So I don't know if there's a third 1,000% in there, but I think it's pretty easy to bet to triple over the next 3 to 5 years. And these are just some other companies that we're looking at. I don't own all of these. Control4, Silver Spring Networks, and this is stuff that we own. I call Google Googlebet. I don't like the alphabet name. Right. But I think Google's the best company on the planet if you could ever get it cheap. So I wrote an article on Seeking Alpha. I don't know what it's titled. How I Prepared for a Flash Crash.
Yeah, I remember that one. Yeah.
And the reason, and what I told people is, look, I accumulated 25% in cash, and then I set a limit order in QQQ. Why QQQ? Because QQQ beats everything, largely because of Google, right?
Sure.
So I like QQQ. It is just a great quick holding. So if you're going to be like me and go on vacation, or you're not in front of your computer 24/7, or you just want to set a limit order and say, hey, this is where I would buy something, I have 3 buy zones for QQQ. I'm not going to buy in that first one, probably. If I do that, it'll be manual. But I have a limit order set in here. And there's a lot of reasons why I talk about them. Google would be the individual stock that if I could get that on a 20 or 30% pullback, I would buy Google. Again, I've owned it before, and here's the reason. I have an intern studying that company, and I gave him what to look at. Google's going to start spinning out companies eventually. And there will be strategic transactions when that happens. So Google will say, we have this division, and there's this company over here. Let's take Google Capital and this division and merge it with this company that's got great technology but needs capital. That's the sort of transaction that Google is going to spin out someday, 2, 3, 4, 5 of them. And those companies will instantly be S&P 500 components. So Google is just, if you're only going to own one stock in the world, find a way to get into Google.
Yep. Take
a look at all the divisions of that company. It's amazing.
Wow, so many actionable ideas today. This has been great. Mr. Kirk Spano is at fundamentaltrends.com. He's on Twitter. Definitely want to check out all of his tweets. He's a frequent tweeter, a serial tweeter, at Kirk Spano, as am I. I'm guilty too. At Kirk Spano on Twitter.
Yeah.
Facebook, Fundamental Trends, LinkedIn, Kirk Spano, if you're a LinkedIn kind of guy. I am. And is there any other way to contact you? What's the best way?
The best way is actually to find me on Seeking Alpha and send me a direct message there. I have the app on my phone. It works out the best.
Yeah, and I don't see why somebody wouldn't want to do that, as well as at least check out all the free stuff on your website, as well as the premium content. Definitely want to see that. All right, Mr. Kirk Spano, I hope you'll become a continual, frequent guest on here. Anytime you've got more ideas, because your ideas are making money. You got 10-baggers in there. At least that one was a 10-bagger twice.
I bought Facebook on the crash after the IPO, so that's when I talk about Peter Lynch, you're trying to get a bunch of those 10-baggers, right? But if you just get 1 or 2 or 3, if everything else basically just kind of hugs the market index, you're gonna kill it.
Yeah.
So you avoid the big mistakes. Don't speculate much. Right. And if you're going to put something into a company like Exact Sciences, you better know what you're doing. You better do the research. I'm lucky. I did the research early, took a small position, and then I made a connection with a guy who is so into this company. I think I know more about this company than 99% of the analysts. There's 2 or 3 guys out there that I think are on par with me. But there's a guy who retired from the industry at 54 years old, and he knows this company more than anybody I've ever talked to. So I'm lucky that I have an ongoing relationship with him to talk about it. He's actually a member of Fundamental Trends, and he just posted a brand new idea, which you might be able to find if you go back and look at that screen, that we're researching right now, and that could be a 10-bagger as well. So the Peter Lynch approach, combine that with dividend growth investing maybe, and QQQ. That's really my approach, is the dividend growth investing plus QQQ plus some of the big catalyst types of investments, which most people wouldn't think Google is that anymore, but I think it is. But most of the companies are smaller, 2, 3, 4, 5 billion market caps versus 20, 30, 40, 50, right? So I have one question for you, Dave, before we go.
Yep, go for it.
What is your best investment idea right now?
My best investment idea, I don't know if investment is the right word. I love to sell out-of-the-money options to people who are bad at math.
I like that.
Yeah, that's, I'm thinking about making a T-shirt saying that. Maybe a bumper sticker, maybe some hats, I don't know. And there's never a shortage of people who are bad at math. I'm looking forward to the day when you can trade options on Robinhood. It's going to be nice, because then you'll have a whole new generation of people that I can sell these low probability options to, low probability on their end.
Right.
So anytime something goes too far in one direction or the other, that's when I pretty much bet that it won't go too much further than that. Because if something, let's say Apple goes down 10% in a few days, what's the likelihood it's going to go down another 10% over the next few days? Pretty low.
Right.
Because the likelihood of going an additional 10% is much lower than the likelihood of going that first 10%. And yet, the options market makes the puts more expensive. It's as if the options market doesn't seem to understand mean reversion. And so I count on that.
And it doesn't. You hit that one right on the head. I've talked about mean reversion in a couple of articles recently, when I told people to sell some very popular stocks, and man, did they get mad at me. Yeah. Some of the emotional articles, and that's the article I'm writing right now, is about controlling your emotions.
Yeah.
But two things with regard to what you just said about selling options. I'll tell you what, selling puts has been one of the best things I've ever done in my career.
Yeah.
I don't use any margin to do it. I just always do cash secured puts.
Sure. And
it has allowed me to accumulate some great positions and collect a lot of cash flow into the accounts, which I get to use for other things. Professionals sell puts.
Yep.
And amateurs buy puts.
That's right.
And that is pretty much reality. It's not always true, but it's usually true.
Right.
The other thing I would point out, just because you touched on something here too, is about information. Jim Rogers, who you know, big commodity investor, and helped George Soros start the Quantum Fund. Probably the most. I think they probably had the best decade ever of a hedge fund, and it's never been beaten since. Jim Rogers says, look, I recognized early in my career that if I just read corporate reports, I'd be ahead of 90% of the people. But then if I went out and read the industry stuff, and I read the reports from competitors, I'd be ahead of 99% of the people. And so that's what I do. My girlfriend, my daughter has been calling me a nerd for years. It took my new girlfriend all of 3 dates to call me a nerd. So, I like her anyway. But, the reality is that studying the right stuff is what you need to be a good investor. Here's the problem. Most people don't have the time.
Right. So
you need a surrogate. And that is what guys like me try to be with these investment letters. Honestly, I consult at $200 an hour, but I charge, $200 to $400 a year for these investment letters, depending if you get it on special. And the reality is you can become your own investment advisor if you just pick the right funnels for getting information, and you take a few hours a week to build a good buy and hold for a long time, but occasionally trade portfolio. Buy and hold forever is baloney. People can say that it works, but the reality is that unless you have a forever time frame, which nobody does, it doesn't. You need to periodically look at your holdings and say, okay, this thing is way above its mean. If it came down 30%, what would that mean for me? Right? In most cases, you're going to want to at least sell your profits out. May not sell the core position, but sell your profits out whenever you've made these giant gains if you think that the company is range bound. Now, if you think the company is breaking out, it's a whole different thing. Exact Sciences, I just kept adding all the way up. That's called pyramiding, and made a fortune, and used some leaps. So there's different ideas out there, but the bottom line is you control your emotions and then do the research, or have a way of getting the right research. You're going to do pretty darn good over time just by avoiding giant mistakes and doing those things.
The website is fundamentaltrends.com. The guest has been Mr. Kirk Spano. Mr. Spano, thank you so much. We'll all be checking out your website and your tweets on a daily basis. Great stuff. We hope to have you again real soon back on Looking at the Markets. Thank you, sir.